Hello, everybody, and welcome to the monthly market memo for the month of December 2025. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk through some of the key charts that shaped our markets for the entire year of 2025, a look back, if you will, and talk about the returns that we saw for the month of December and for the year, as it were, in 2025. So without further delay, let's go ahead and jump into it. We did see stock markets eke out a very small gain if you look at the S&P 500 for the month of December. This would and did make 8 months in a row that we've seen positive gains for the S&P 500. So just a really great streak ever since we had that volatility in April, which I'll talk about here in the next couple slides. But so far for the month of December, it was very barely positive for the S&P 500. International stocks are actually up over 3%. So we kind of ended the year the same way the whole year shook out. International stocks led the way for December and they led the way for 2025. They did add the most value likely in your portfolio. Now we look at that right now, and as I show these green bars, the international stock market was up about 32 to 33%. So just an amazing year for international stocks. Some of that has to do with the increase in currencies against the US dollar overseas. We saw some positive catalysts regarding changes in Japan and spending over in Europe, which boosted share prices there. But it wasn't really a bad year anywhere. We saw the S&P up close to 18, small caps here in the United States up close to 13. Again, double digits for all those three major stock asset classes we track. And bonds, which we talked about a lot this year, now we're up almost 7%, just a little over 7%. So even boring bonds delivered a great return in 2025. And if you note, cash still did well, absolutely beat inflation, no volatility, was up over 4, but everything did beat cash for 2025. US bonds, stocks and overseas, US small cap stocks, and of course the S&P 500, everything beat cash here in 2025. Just a great year, but it wasn't without its volatility, right? We wanted to go back and kind of rewind and show you some of the key themes on how this shook out in case you kind of forgot, these years go fast. But in April, the markets were upended as the tariff rate skyrocketed. Basically, you see here this kind of busy chart, but at the beginning of the year, in the bottom left-hand side, you see about a 2% effective tariff rate from Wells Fargo. This is how they look at it. And then early April, Liberation Day happened. We hit tariffs across a lot of different countries. China was hit heavily, and we came to over 30% effective if they would have stayed there. And then you saw the stock market really react to this news very quickly, as it always does. It discounts, negative effects on GDP. It's going to discount the negative effects on corporate earnings as a result of all this tight and large tariffs and potentially higher inflation. You saw about a 12% decrease from the from the month of April. So that discounted in the stocks very quickly, going from down to 12% in just a couple days. But the good news was, we cooler heads did prevail, if you will. The tariff rate did stay high, but by the summer, the tariff rate did come down to about 16% or so and really just stood there. Went up maybe a little bit, came down a little bit, and that's kind of where we ended the year. So we did see that material decline as deals came across, right? Exemptions were made on chips and other areas of key industries. And really, it was a negotiating tactic as we look back at it, and we got a lot of things that we wanted to get out of it. Stocks ended up trading towards the end of the summer, kind of around the end of the second quarter at least, back near an all-time high, if you will, at the end of June. So we saw just a lot of volatility on the downward side and then really skyrocketed back up, and we closed out the year very strong, as I showed you in the previous slide. So tariffs were a big key theme in 2025. This led to my second key chart, which is looking at inflation. Now, we did see a higher tariff rate than where we started the year, of course, but we did not see a big jump in inflation. It did stay sticky. It did stay higher than what the Fed wanted, but we didn't see it get out of control. And a lot of that has to do with what I'm going to show you here. We look at inflation in two different ways in this chart. Goods, a lot of goods we import, those are subject to tariff rates. those absolutely did move higher here in 2025. As you see, it was basically negative inflation for a while after we got through COVID, and then or deflation, and then we saw a big pickup in goods inflation. But that's not the only side of the coin. The other side of the coin is services inflation, how much we pay for, going out and doing services, receiving services. And that stood to decline here in 2025. So those two kind of offset each other. Goods inflation caused the overall inflation to be a little sticky, be a little higher than what we wanted, but overall did not get out of control. Other things we looked at when I was preparing these charts for you was housing inflation is this blue line that I'm showing. Started the year over 8%, or sorry, started 2023 over 8%, really ended towards the end of this year under 4%. So just housing continues to increase at a slower pace than what it was. And then we also saw wage growth, which is, for those of us still working, the growth of our wages has been slowing, which is good for overall inflation. As wages come down and kind of cool down from where they were at the pandemic, we're able to, still support the economy, of course, but not go out and spend all the dollars and drive up that inflation that we saw after COVID. So inflation was in check, even though tariffs were high. That's our key themes one and two, and a lot of this led to key theme number three, which was inflation was sticky but not out of control, and the jobs market was cooling. The Federal Reserve has two mandates: stable prices and low unemployment. So stable prices, let's just say, kind of a traffic system, a yellow light there. Not red, not getting out of control, not green by any means, not where they want it, but it's yellow. It's stable. On the other side, unemployment had been increasing, jobs growth had been slowing, and you saw the Federal Reserve really make a pivot in Jackson Hole when they talked about focusing more on the labor market and providing relief via the federal funds rate for us consumers. So we saw them resume rate cutting 1 year after basically they started it in 2024, and they resumed it here towards the tail end of 2025. We cut by about 75 basis points down to 3.75 percent on the federal funds rate, and we cut one, two, three times total. So three 25 basis point cuts. So all in all, of easing Federal Reserve, getting that Federal Reserve funds rate back towards where they believe neutral should be, where inflation is in check, is good for stocks. It's also good for corporate earnings. So the last couple slides I wanted to share with you here for 2025 was some really reasons why the stock market went higher. We saw corporate earnings get to new all-time highs. Really, we saw 3 quarters in a row, I believe, maybe more, of double-digit earnings growth year over year. So, just a fantastic year for corporations. Profit margins stayed stable even with higher inflation and higher goods inflation, especially. Profit margins were still approaching an all-time high as well. So the reason why we invest, right, is for participation with those stocks, and earnings is one of the key reasons why we saw the stock market grow in 2025. And then finally, GDP. GDP came in negative for Q1. And then we saw, as you kind of see here towards the right-hand side of this chart, you saw that negative bar over under zero. And then we saw some really above trend growth for Q2, Q3, and we're expected to see still good growth for Q4 when those numbers come out here in early 2026. So earnings growth was solid. GDP was solid after that bad Q1, but a lot of that was front running for the tariff relief. And corporations just managed this very, very well. Of course, the S&P 500 led the way here in the United States. So all in all, it's just a fantastic year. Double-digit growth out of a lot of individual stock markets we track. Bonds were even up over 7%, and cash was positive over 4%. So fantastic year. Thank you for watching all these videos throughout 2025. Thank you for your trust. We approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we're completely committed to you. You can always follow us on our website, reach out to us via phone. You can email us. You can Of course, call your financial advisor with any questions as we come into 2026. In my next video, I anticipate to kind of hit some of those outlook slides for the rest of this year, of course, as we turn the calendar for a new page of the year and talk about what will be some of the key themes we believe for this calendar year. So again, thank you for watching. We hope you had a great 2025 and look forward to talking to you more in 2026. Thanks, everybody.